In this video, we will explore about the supply and demand dynamics of commodities. When you look at the stock market, you usually study a company's balance sheet, its profit and loss account, and how well the management is performing. However, looking at the commodity market is quite different. Here, the analysis depends largely on the supply and demand dynamics of that specific good. It is less about a single company and more about how much of a product exists versus how much people want it. On the supply side, everything depends on availability and the capacity to produce. There are 6 main factors that determine this. These include the cost to produce the item, government policies, the level of technology used, geopolitical events, weather conditions, and the actual production levels. Let us break these down to understand how they change the amount of goods available in the market. First, let us look at the primary drivers. Production levels are key, which means looking at things like crop yields for farming or drilling capacity for oil. Then we have weather and natural disasters. Events like droughts or floods can destroy crops and stop energy production. We also have geopolitical events. Wars, trade restrictions, and decisions by groups like OPEC can drastically change the supply of energy and metals overnight. Moving on to the next set of factors, we have technology and infrastructure. Better farming methods or faster transport can reduce the risk of shortages. Then there are government policies. Things like subsidies, tariffs, and export bans change how much supply is allowed into the market. Finally, we must look at the cost of production. If labor or energy becomes more expensive, it costs more to produce the commodity, which can reduce the supply. Now, let us switch over to the demand side. Demand is all about who needs to consume the product and how active the economy is. This is driven by 6 major areas. We look at global economic growth, seasonality, industrial needs, consumer preferences, population growth, and the availability of substitutes. All these factors combine to tell us how much of a commodity the world wants to buy. Let us look deeper into the first 3 drivers of demand. First is global economic growth. When the economy expands, factories need more energy and metals, and people buy more food. Next is industrial and infrastructure development. Building roads and houses requires steel and copper. Third, we have consumer preferences and lifestyle. For example, a shift toward renewable energy creates a huge demand for metals like lithium and silver. The next 3 drivers focus on population and timing. Population growth and urbanization naturally lead to higher needs for food, energy, and housing. Then we have substitutes and alternatives. For instance, electric vehicles reduce the need for oil, while plant-based foods might lower the demand for meat. Finally, there is seasonality. We see higher fuel demand in winter for heating, and festive seasons often cause spikes in consumption. Geography also plays a massive role in these dynamics. If you look at the map, you can see that specific regions control specific resources. For example, copper is heavily affected by weather and labor strikes in South America. On the other hand, crude oil is sensitive to geopolitical tension and wars, such as those involving Russia or the Middle East. Meanwhile, local economic conditions can create sudden demand for precious metals like gold and silver in specific countries. We must also understand the flow between nations. We have producing nations on one side and consuming nations on the other. If everything is smooth, trade flows well. However, issues like slowing growth, political instability, or sanctions can act like a roadblock. When this connection is broken, it results in a constrained supply and disturbs the balance of the global market. Now, let's talk about money. Since commodities are traded across borders, currencies matter. The dollar index is a very useful tool here. It measures the strength of the United States dollar against 6 other major currencies such as the euro and the Japanese yen. Because a majority of global trade happens in dollars, the strength of this currency dictates prices. There is an inverse relationship you need to remember. Think of it like a seesaw. When the dollar strengthens, it goes up and commodity prices usually go down. This is because a strong dollar makes commodities more expensive for buyers who use other currencies, so the demand drops. Conversely, if the dollar weakens, commodities become cheaper for foreign buyers and prices tend to rise. Since these markets are global, there is a strong link between international markets and domestic markets. The big international exchanges set the benchmark prices. For agriculture, we look to the Chicago Board of Trade. For gold and silver, it is COMEX. For energy, it is NYMEX. And for base metals, we watch the London Metal Exchange. The prices you see on Indian exchanges are essentially replicas of these global giants. However, the price does not just copy over perfectly. There is a process. The global benchmark price travels through currency fluctuations and trade policies before it becomes the domestic price. This concept is called import parity. While global prices set the tone, a weak local currency or high tariffs can amplify the costs significantly for the local buyer. For agricultural commodities, we rely heavily on data. Crop reports are essential. They give us data points like how many acres were planted, yield estimates, and current inventory. The rule of thumb is simple. If the report shows higher than expected production, we see a price decline. If the report projects lower output, we see a price increase. Weather reports are just as critical because farming depends on nature. For example, delayed monsoons in India can hurt rice and sugarcane production. Adverse weather in Brazil can ruin coffee and soybean crops. We also watch for major climate cycles like El Nino, as these can shift global supply chains and cause massive price movements. Another major indicator is inventory data. This tells us how much of a product is sitting in storage. Think of it as a warehouse. If there is high inventory, it means there is too much supply, which leads to price pressure, pushing costs down. If there is low inventory, it implies scarcity, which leads to a price increase as buyers compete for what is left. We also have to balance production trends against consumption trends. Production is driven by technology and policy. For instance, if OPEC increases output, we get lower prices. Consumption is driven by industrial needs. If there is a sudden surge in demand without a matching supply, we get higher prices. It is always a race between how fast we can make it and how fast we use it. Beyond just the product itself, the big economic picture matters. We call these macroeconomic indicators. GDP growth is a big one. Strong growth means factories are busy, boosting demand for energy and metals. Inflation is another key factor. When inflation rises, investors often rush to buy gold as a safety net, and the cost of producing goods also goes up. The economic cycle continues with interest rates. High interest rates often strengthen the currency, which can lead to lower commodity prices. We also look at other indicators like employment data and consumer sentiment. Combined with trade and geopolitics, these factors tell us if the economy is healthy enough to support high commodity prices. Government policy acts as a gatekeeper. Governments frame policies to protect their domestic markets. They do this through import and export regulations, subsidies on things like fuel, tariffs, and environmental regulation. These decisions can artificially change the supply and cost of commodities within a country, regardless of what the global market is doing. Finally, we have to look at the risks. Geopolitical impacts can cause sudden shocks. Supply disruptions like conflicts in the Middle East can cause a sharp increase in oil prices. Trade wars and sanctions can restrict the flow of goods. Strategic alliances like OPEC agreements affect pricing power. All these add what we call risk premiums, making commodities more expensive due to uncertainty.